Today, I wanted to hit on really three things. Just an overview of what happened this week in the markets, the indexes. I want to just talk about volatility because all of a sudden that has become a big event, and it's an indicator that we can use to better protect ourselves, but also take advantage of some opportunities. I wanted to hit upon a handful of carry stocks and then two stocks that I'm got my eyes on. This week has been really interesting. Well, not interesting, sort of nerve-wracking for some. For others, it's been opportunities. This is a picture of the S&P 500. 200-day, as Mark has always pointed out, is a really big line in the sand. You cross this line, you die. If you cross this line, you go higher. Well, today, for the last basically since October or February 20th, we have just been seeing selling, couple up days, really three up days in that time frame. But yesterday came down and hit the 200-day moving average. And today we went through it, but we closed above it, which possibly could be a sign that maybe all this selling is done, at least for a while. One thing I look at is when I look at this, the blue line here is the 9-day moving average. And as you can see, it's come up against it back on March 3rd, made an attempt around March 5th. And it looks like it may, depending on what happens, if tomorrow was Monday, there's a sign, a good sign that we could see a move higher up towards that 9 again. But when you look at this, we're right now in a very downtrending market environment. The news is more downtrending. We're now seeing, Bob pointed out that Steve Bassett, the Treasury Secretary, was on CNBC for 45 minutes and pointed out they're basically trying to push the U.S. 10-year Treasury downward. And that is because we all finance our debt typically on U.S. Treasuries. And so what we're seeing is this pushing down of on the U.S. 10-year Treasury yield along with other treasuries. And that pushing down is caused by money flowing in or buying those bonds. Well, where does that money come from? And that's sort of been the big question here the last couple of days is where has money been going and coming from? And the chart on the left here is the US dollar. I use DXY as my benchmark. And as you can see, we have continuously sold off the dollar since January 13th of this year. We've had some spikes March 3rd, but closed lower, along with a continuation and then a big sell-off on March 4th, 5th, 5th, slowing on yesterday and a close lower today. We closed above our lows of the day, but we're lower. The dollar is now worth $1.03 and some change. We've seen that similar selling in the S&P, and we've seen yields go up, 10-year yield. So if you remember, when bond yields go up, value of bonds go down, and vice versa. Well, we're seeing yields for the last 1, 2, 3, 4 days has been going up. But since really, what is this? January 14th, yields have fallen from a close of $4 or 4.79% yield to its low of 4.24. We've bounced a bit, hit some resistance here on the 15-day moving, but we're still above that 200. So when I look at this, I go, money is flowing out of the US dollar, it's flowing out of the S&P, and it's flowing out of US Treasuries. Now, Steve Bassett pointed out that they're trying to push money into Treasuries and eventually will push the yield down and the value up so that debt can be refinanced and all that. So what I'm seeing is a very downward moving U.S. equity market. Something I brought up on the Morning Edge call earlier this week was volatility. For a long time, we have not seen volatility at this level. So if you go back to December 23rd, volatility, the VIX, which is the volatility, measures the volatility of the S&P 500, basically stayed pretty below the 18, 19 mark. Anything below 19 is investable. So markets, S&P goes up typically when the VIX is below 19. Above 19, up to 27, I refer to this as the chop bucket. This is where markets go up, they go down, they go up, they go down, they sort of zigzag. When you think you're at the bottom or at the top or at the bottom, it rips higher, and then the next day it rips lower. We saw that earlier throughout this week. Well, today we presently closed at 23.43. We got as high today on the VIX of 26.56, but we've seen this continue movement higher in volatility. The concern I have is with what's happening with talks about tariffs, talks about different things that are going on throughout the world, backing out of the Ukraine, supporting them in a sense. It's created a lot of volatility in the market. Now, this is great if you're a day trader or a swing trader. You catch some bottoms, get a rip up higher. But when it comes to getting above this 27 mark, I call that the F bucket. This is when things go bad. We saw that. I'll pull up a weekly chart here.
Sit down there.
What's that? You can see back in February of 20, we busted above the 27 line. We saw that back in 18. We saw that back in 08, October of 08. Whenever anything gets above that 27 line on the VIX, things go bad and markets sell off. Well, today or this week, hold on a second here. This week, we got close. And that's still a concern of mine. And I suspect it'll pull back next week. We've had a lot of selling, right? A lot of companies seem to have gotten to some level of fair value. We've seen the Mag 7 sell off. We've seen a lot of AI stuff sell off. But we're still in this chop bucket. We could have another week where the VIX pulls back towards 19. That would be understandable. Profit, people buying the dip mentality kind of idea. Buy the dip, have it rip higher a little bit, and then at some point maybe it tops out and moves lower. And so what I'm keeping an eye on, especially right now for the rest of this month, is this VIX indicator. And I'll touch upon it pretty much every day next week on the Morning Edge call. So this is really a big indicator to me. When the VIX is below that 19 mark and goes down towards this 13 level, markets go up, stocks go up. That's a great time to be in stocks. So right now we're seeing more downside pressure than upside. Let's hit upon a couple stocks in Carrie's portfolio. It's me here. So I know everybody likes the AI stuff. So this is AEHR, and you'll see that pretty clearly. I use this indicator that gives me an idea where buyers are and where sell orders are. And right now, AEHR is AEHR Test Systems has been on a downtrend. This is a weekly chart, actually. So when you're looking at each candle, that's a weakened time. So we saw a pullback starting in January 6th in AEHR. It went through, it was below the 200 week, which is 3.8 years. The 62, which is my yellow line, that's just over a year, about a year and 10 weeks in time. And then the 15 week is my white line. I use those more on a daily indicator chart. But what I'm seeing is continued selling in down into a support area where there have historically been buyers in this area. So when I look at this, I go, okay, what I want to see happen is a reversal off this area where it came down to this week and start moving back up towards this resistance area of 1338. Now, if you're sort of swing trading this or more like a 3-month period kind of trading this, this could be a great opportunity. But let's keep in mind that markets in general have been selling off. So you want to really think about how you're positioning yourself in this environment. And at $8.85, it's a pretty low cost position that if we do see an uptick back into risk on, this could be a big profitable kind of in short term possibly trade, but you're still running into a lot of resistance. When you go to Modine, I need to do that. This is Modine Manufacturing. Carrie holds this as well. This is a weekly chart. Once again, we're below this 62-week period. We're below, we're headed towards right now. There's support right around 4704 or so, where the 200-week moving average is. What concerns me is this the time to get into this? I mean, there seems to be some level of support in this area. And my answer is I'm not ready to see an accumulation process happening because we haven't seen any sort of bottoming. I don't see any where buyers have been in the past. Buyers are more in that roughly $50, $47 to $50 range. So as long as there's a risk off attitude, Modine may be a wait and see and put it on your grocery list as something that if we get down another 40% down in this stock, it could be a great opportunity. Now, things could turn around. It could move higher, but I do believe there's resistance up here around 103, which still would be a good if you're looking for a more of an intermediate trade type thing. But I do think just the overall macro environment, we're more on the negative side here. And then Vertex Holdings, we broke below that 62 period. Could be considered some support in this area. There is more buyers in the past down here around 72 range. But once again, it's a continuous downward trend. We want to see a reversal, a bounce off, a week or two of movement up before really getting deep into it again. Two companies I've been looking at around the whole AI movement. And recently, after DeepSeek came out with their program and how they did it and how much it cost to develop it, around 5 million or so to develop it, and that they're doing it on old NVIDIA chips, all of a sudden you're starting to see headlines about other companies who are starting to jump in out of China, jump into the AI game. And Alibaba was one of those this week. This is a weekly chart of Alibaba. Alibaba, I think we mostly know of them for is cheap Chinese online retail. They're sort of the equivalent to Amazon, but they have been developing AI technology, and they came out with a large language model that is supposedly just as good in some aspects as DeepSeek, but is sort of missing in some areas. And the way they designed it, the way they trained this model is a bit different, a bit more segmented versus DeepSeek is more broader. And it's starting to show signs of this could be another competitor to OpenAI, to Anthropic, which is Claude AI, along with a handful of others. And when I look at this kind of stuff, I go, where is it coming from? Well, it's coming out of China. China has been in a recession for quite a while. Um, Granted, you can't always believe their numbers, but they are starting to come out of that recession. And Alibaba could be one of those opportunities that could be a play from one, the AI angle, and two, a coming out of a recession environment angle. And so this is a weekly chart. And as you can see here, at one time, Alibaba was trading at right around $310 a share. It has come down, and for the last roughly 2 years, which would coincide with China's recessionary environment, has been moving sideways. And here recently, in the last 1, 2, 3, 4 weeks, has made a break higher. As Bob said once a couple of weeks ago, I just want to make money. And when I look at where money is flowing, I'm seeing money flow out of the United States, as seen with the US dollar, US treasuries, and US S&P 500. And it's starting to make its move across the pond towards, do they call the Atlantic the pond or the Pacific, or can we call them both a pond? I think the Pacific, whatever, is the Asian pond. We're seeing movement towards China. Alibaba, I think, could be a possible play from the intermediate to long-term perspective, just the way it's setting up, and then also just this focus on AI. And of course, the Chinese government wants to get behind it as well. So I think you're going to start seeing some opportunity in China. And Alibaba seems to be one that you can play from both the AI aspect, but also the retail recovery aspect in China. And then one other, here in the United States, the biggest thing we talk about a lot of times is energy and these data centers, and how all these companies are building out these data centers. Well, what's the number one thing that these data centers need? They need energy. Two, they need cooling. When Meta signed a $10 billion deal to build off I-20 down in Louisiana Parish and build a $10 billion data center, they went to where energy is. Well, Range Resource Corporation is a small natural gas production company. They are out of Fort Worth, Texas, but they primarily do their drilling and exploration in Pennsylvania I'm going to butcher the name, Marcellus Shale area, I think it's called. But they get 68% of their production is natural gas. Well, what are these data centers building their energy source on? Natural gas. And this is a company that presently trades, closed today at 35.22. It's above, on a weekly basis, it's above the 200. It's above my 62 range. And I look at this and I go, this is a company whose revenues have increased this past quarterly, year over year. Is it super profitable? Not as much. But as I see this AI development, this data center build out, more and more energy companies specifically focused on natural gas, I believe are going to become the go-tos when it comes to powering these mega data centers. And if we continue to see the amount of spending on data center development, these gas or natural gas companies could be a big win over the long term, in my perspective. I do think that we are in another at least 30-day market volatile downtrend. I think you I mean, after this week, the hope is that, with the S&P closing up over the 200, that next week it'll be the beginning of a reversal and we start to move higher. But I believe we're more in an environment where we're going to have a bounce next week. Hope will come back into the market. The retail investor will ante up even bigger. And even though it sounds just cruel and unusual punishment, as we get into the week after, which is one of the biggest quarterly option expirations on the 21st, you have index options, derivative contracts, and future contracts, along with index options expiring on the 21st. And this is basically, this quarter has been a mega option expiration quarter. You've seen trillions of dollars in options being transacted and expiring. I think you're going to have possibly another up next week, but the following week you're going to have a pullback. And what I see with the presidential administration, what they're trying to do, they recognize they've got, roughly, 7 to 9, $10 trillion that they have to refinance in the next 6 months. And a lot of that debt is old debt that was financed at 1, 2, 3% rate. Now your 10-year treasury is up around 4.25 or so. Their goal is to get that 10-year yield down, get mortgage rates down, and it's going to take some time, but I think you're going to see a push for lower yields. My projection is 3% on the US 10-year treasury by sometime in July, which then if you're a guy or gal has a 5-year arm on a mortgage, add 1 to 3% depending on credit rating to that 10-year yield, and that's what your target probably mortgage rate's going to be. Right now, if you add 3% to that, your mortgage rates could be in the 7s to 8%, depending on credit level. And a lot of people can't afford that right now. And a lot of people can't afford to pay their credit cards right now. So I think this administration is just really, really working hard to push yields down, which means money's going to come out of the equity market, and you're going to see prices on high beta stocks, high risk stocks is going to go lower, which creates an incredible opportunity for all of us over the next 3 to 6 months. And I look at this and I go, this is what we always want to buy. I always look back and go, God, I wish I bought back in 22, or I wish I bought in April of 2020, or I wish I bought in November, or excuse me, April of 2009. Because everything was on sale. There was blood in the streets. The tide had gone out, and you saw who wasn't wearing a swimsuit. And that's when we want to buy. And I look at this environment we're in, and we, in my belief, are starting to line up to getting that opportunity. And so watching the indicators like the volatility index, watching the US dollar, watching the US 10-year treasury, these are things that we just keep an eye on them, check them a little bit every day. Doesn't have to get real deep into it, but as long as we start to see this stuff come down and we get to prices where things become reasonable. I'll give you an example. I talk a lot about NVIDIA on our TikTok channel, and I think NVIDIA around $90 a share is going to be the prime time to start dollar cost averaging into it. We saw the movement in NVIDIA today. It sold off down towards 105, which is what I had calculated in my calculator. Anybody who's gets the free NVIDIA email got that today. So I do see downward side pressure. So be careful of the dead cat bounce that we may see over the next week or two, but start making your grocery list. What is I want to add to my portfolio? What would be stocks that could perform incredibly well over the next 6 to 36 months? Start making that list, start watching them, studying them, and looking for where buyers are starting to come in and starting to build support levels to where you can start adding to your positions and building out your portfolio. I honestly believe the next 36 months could make a lot of people a lot of money. It's the short term that is painful, and that if you can step back and see the whole picture and how it's working out, it can be a big benefit to you all.